here today for 5 reasons real estate investors overpay the government. And I want to welcome you to the Real Estate Investing Made Simple club meeting is really what this is with LeAnn Riley. And I do live interviews with experts and leaders in the real estate industry nationally. I'm LeAnn Riley. I'm a national real estate coach, and I lead the Encore investment team of realtors in the Twin Cities, Minnesota. And I built a multi-million-dollar portfolio in residential, multifamily, condo development, commercial, and vacation properties. I had some down in South Carolina is my favorite spot, Edisto. Anyway, as a national coach and trainer, I help investors build a step-by-step roadmap to wealth by creating a real estate portfolio of cash flow properties. And I provide education with my Real Estate Investing Made Simple Club and Facebook group. And I do have a YouTube channel. If you want to look back at all of these live streams I've done for many, many years, it's LeAnn Riley Real Estate on YouTube. So if you get over there, subscribe. So again, today, our topic, 5 reasons real estate investors overpay the government.
Yep.
And my guest right here is Chris McCormack, and he is a CPA and a certified tax coach, and he focuses on real estate investors. That's why we got to talk to him, right? And he's the host of Know Your Numbers REI podcast. So I bet he has tips over there too. Do you, Chris?
Yes, that's correct.
Okay, probably. And how often do you do your podcast?
It's about 2 times a month at this point. Yep.
Okay, so a couple times a month if you need some more tips.
Yep.
All right. And he is the CEO of Better Books, and that is a tax planning and accounting firm. And before starting a firm of his own, he spent a few years in public accounting. And he worked at PwC Boston. He is committed to helping real estate investors navigate the complexities of the tax code and getting them to pay as little in tax as ethically possible.
Yeah.
We like that because, you know, that is the reason a lot of people actually invest in real estate is for that depreciation or whatever they can get to get the high income people to get their income down. And so we need to know any way that we can do that. And there's a lot of ways.
Yep.
So really glad you could join us today, Chris.
Well, thank you for having me, LeAnn. I'm excited to be here with your group. I know you've helped a lot of people in many different ways, both from teaching from your experience and just helping them along the path of real estate and wealth building. So it's great to be here.
Yep. I love real estate. I can't help it. I mean, I'm telling you, I can, you know, driving down the road, I went up north this weekend to see the fall colors, and right away I'm like, ooh, there's a house, you know, there's a good house. It looks like it needs some work. Wow, there's a deal. I just can't help it. So, you know, you got to do what you love, and you must love numbers, right?
Oh yeah. I love real estate too. It's a hard industry not to love. There's so much to it. So I'm excited to unpack it here.
Good. Okay, so I'm curious, what had you leave the big firm and open your own business?
Yeah, great question. So as you mentioned, I started in public accounting, and I don't know how many people are familiar with the world of public accounting, but it's very busy during the months of January through April. And during that time, I was working with some of these big corporations, insurance companies, financial service companies, banks, real estate investors with a large portfolio. And I started to realize that they were using strategies that I knew would work on the smaller scale, but a lot of the people on the smaller scale that I knew weren't fully aware of them. And so I figured if these guys can do it to build their wealth that they currently have into a bigger amount of wealth, then why couldn't I do that for the smaller guys? So but very passionate about entrepreneurs, very passionate about real estate investors, just people who want to leave a legacy and provide for their family and achieve their dreams. So a lot of what I learned at PwC is now being implemented with our clients today. and my knowledge continues to evolve in this field, and I get to meet a lot of great people, and it's fun to know that they're taken care of and they're achieving their goals as well.
That's really great, because you're right. Some of the newer real estate investors, they can't afford the big firm, but
Right.
they need someone to getting started in real estate. What kind of entity? There's so many questions. We're going to talk about some of them.
Mhm.
So, I have to read one more little thing, a little disclaimer, kind of
Yeah.
both of us. Remember that tax laws are subject to change, and your specific situation may have unique factors.
Mhm.
Always consult with a tax professional or a CPA who's familiar with real estate tax matters for compliance and maximum tax benefits. And that's for both of us. We have to speak to you today in general,
Yeah.
right? And and you can ask questions, but for further details that are more personal, you're going to have to speak separately about
Yeah.
your personal situation. So first, for a really quick review, what's the major tax deductions that are standard for real estate investors?
Yeah, so most people are familiar with the fact that in America, we're blessed to be in a country that incentivizes entrepreneurship and investing. And I think it helps to wrap your head around why that is, right? So the government knows that you, as a real estate investor or small business owner, are able to provide value in an industry that comes better than the government would be able to do that. And so they want to incentivize you to do that to the highest extent, and they do that through tax incentives. So for real estate, it's anything that you're able to anything that you're paying out that adds value to the tenant or to your business. So for example, you own a property, you pay mortgage, and then you also pay interest. So one thing that is very clear is that while you can't deduct the full amount of the mortgage, you usually can deduct the interest, and it depends on the type of property. And this isn't a benefit that everybody gets, depending on whether it's their primary or they're a full-on investor. But it's really anything that you are paying that is going into the operation of your business. And so that could include taxes, utilities, a whole host of different expenses. But the beautiful thing about real estate is a lot of those expenses are expenses that you usually take on as a homeowner, but now you're able to do it and generate income on the side too.
Definitely. And like I said before, depreciation is a big piece that helps, or even losses on rental property can, some people buy major just for tax benefits. They
Oh
might
yeah.
be the absentee landlord, right?
Right. And so depreciation too, it's important to be working with a real estate specific tax expert, because something like depreciation, yeah, a lot of people know about it, but whether you're getting the full benefit on it is dependent on your situation. And I've seen enough people come through our doors where they weren't getting the full amount of depreciation, or they weren't getting it to the extent they could have, and it's cost them big time in tax dollars. So we'll talk a lot about working with the specialist and the importance of working with a specialist, but also know that these big buzzwords like depreciation and some of the others that we might cover, you might hear about them, but it's important to work with somebody who knows exactly the benefit that you can get out of it, so that you can have that confidence and you're not flying blind and paying for it too.
Yeah, paying extra. That's
Yeah.
really what it is, paying the government extra.
Mm-hmm.
So then how could an owner maximize their deductions for rental properties? What's something that they could do?
Yeah, I think the biggest thing is just meeting with an expert, like, because without looking at your specific profile, getting into your goals, getting into your pains and challenges and where your portfolio is, then we don't fully know. But I think the first step is getting that conversation on the calendar, making sure that it's before year end, right? Because a lot of these deductions happen during the year. So if you have a big expense that you want to invest in, but you wait until January, well, you might pay more in taxes. So not only did you take that big expense in January, but now you have a big tax bill in April as well. So I think it starts, LeAnn, by getting that meeting on the calendar with a real estate tax specialist before year end, so that we can dive into your unique profile, see what you're currently doing, where you want to go with it, and how we can plan around it. Because a lot of these too, like depreciation, there's ways, and we'll get into some of the more advanced strategies, I think. But like there's the advanced strategy, for example, people talk about cost segregation. I can't tell you how many people come to us and they're like, I want to do cost segregation. And we're like, okay, have you met with somebody who has told you that cost segregation fits your need, or is this is the best time to do it, right? Because timing is huge in the world of tax planning. So you get this insight by getting a meeting on the calendar with a real estate tax specialist, somebody who has time to sit down with you, get to know you, dive into your unique situation, and then use that to create a plan to save on tax.
It's critical. I just had a tax planning meeting because I'm doing a new joint venture. And what I found out at that one meeting, I call that a $10,000 or $20,000 tip.
Oh yeah. Yeah.
It was a tip. It was something I didn't know, and I wouldn't have. Basically, the joint venture gets to choose how do they want to be taxed, C Corp, S Corp, whatever. But if I don't fill out the right form in 60 days, I think it was 75 days, I believe it was, then it would be too late to decide that. I didn't know that. Right there, I was like, oh my God, that's huge.
Yeah. Oh yeah. I just got off the call with somebody today who, when we originally sat down, they had somebody set up their entity, and come to find out they were hesitant about it. They were confused. They were concerned around what it was and whether it was the best thing for them. They sat down with us, and if they hadn't sat down with us, it would have cost them about $20,000 extra on every $100,000 they make. So it's,
yeah. And it's just something that the average person, we don't know that. We don't need to know all that.
Right.
We just need to find the right person who does know it, who can take a look at whatever we have and give us the right advice.
Absolutely.
So I'm right with you there. Okay. So what tax credits are available kind of like right now for real estate investments? What's going on?
Yeah. So I did a podcast recently about like the 5 areas that the government incentivizes. So if you, again, think back to the government's point of view, you think, what industries and where does the government want to see expansion? And so the industries that I mentioned were tech. So we had tech, we had real estate, we had business, we had energy, and we had charity. So those are 5 big areas that we look at. And if you think about it, like tech, that's where things are expanding. That's where a lot of this, I mean, you think about artificial intelligence and robots and general intelligence. And so the government is incentivizing that, and they'll do certain tax credits in that area. Something like charity, like they want their people to be very charitable and generous and giving back to those that are less fortunate. Real estate. Now, when you're a real estate investor, yes, your plan is to build wealth, but you're also providing a home and a place of living for your tenants. And so the government is incentivizing you to go and invest that. And so really in 2017, we had a big tax overhaul. Donald Trump and his cabinet passed a big tax overhaul that allowed for things like cost segregation and different credits that, if you're on the outside looking in, you might not know about. But it was for things like real estate to be incentivized, for you to take your dollars, invest in real estate, and the government is going to pay you to do so through the form of tax credits. So to answer your question, LeAnn, there's a whole host of different strategies, but real estate is one of the areas that the government has its eyes on, and tells people like yourself to go and put your capital so that their citizens can be provided for and have a place to live. And especially now with interest rates where they are, real estate investors are there's no extra strategies coming out of the high interest rates, but it is a place like the need for a qualified real estate investor who can provide an affordable place for somebody to live is greater than it was even 10 years ago.
Well, there's that 4D program, like here in Minneapolis, for affordable housing, you're going to see more programs, and there's opportunity zones, but the typical investor just doesn't know where they even are. They don't realize that if they bought in a certain spot in Minneapolis, they might be in an opportunity zone.
Right. Yep.
Those kind of things can make a difference.
Mm-hmm.
And they make a difference of how the tax preparer does things and how they could, but gosh, if you don't have the right person, they don't even know what an opportunity zone is.
Right. And if you have the wrong person, they might think an opportunity zone is what you need, but then they won't tell you the whole detail about opportunity zone being phased out in 2 years and the benefit going away. So it's like timing is huge, knowledge is huge, and again, it's far too much for some tax people to even understand, let alone the real estate investor, which makes it all the more important to meet with somebody that can dive in and tailor something exactly to your needs.
Well, and now my next question is about how does depreciation affect my tax liability? And I remember something for me that for a while, we just took the major depreciation on each building, but then I don't know when this was, 5 years ago, 7 years ago, they sort of changed it for your equipment and some of those smaller things your appliances, you could depreciate them out differently, and that made a difference. That helped.
Yeah, absolutely.
So, how does depreciation affect your tax liability? It lowers it, right? Technically.
Yep. So this is one of those things where, again, it depends on your unique situation. So there's two different ways to approach real estate, right? In the 1980s, there were a bunch of high income earners, doctors, lawyers, business owners who were using real estate, taking advantage of the depreciation, as you mentioned, LeAnn, and basically writing off their entire income amount, their $600,000 salary that they were getting from their law practice because of the benefit of depreciation. So again, the government comes in and says, okay, this is a little bit too much. So we're going to pass a law that says real estate is a passive activity. And as such, the losses that you generate through the use of depreciation is now classified as a passive loss, unless you can qualify for it as an active activity, meeting some requirements through the real estate professional loophole, but it's also not a loophole because it's just in the tax code. And so it really took the benefit of depreciation and made it only for a specific amount of people. Now, does that mean anybody who qualifies as or doesn't qualify as a real estate professional doesn't get the advantage of real estate? No, there are ways around it, and that's why it helps to plan with a tax specialist. But the government did kind of get out on top, and now we have to take a deeper dive into, okay, what is your income source? Are you active? Is there a way to make you active? Are you passive? Is there a way to tailor it so we can still get the benefit even though you're passive? And that is all done through a comprehensive tax plan and meeting with a tax specialist. So that's a very wide array of saying, yes, depreciation is one of the best benefits to investing in real estate, but you have to go at it in a specific way in order to reap the full benefit. And that's one thing I say is, like, people got into real estate for 4 reasons, right? Is income, appreciation, taxes, and then leverage. And if you don't have those 4 things, it's kind of like driving a car with only 3 of the 4 wheels, right? It might go a little bit, but it's not going to go the full distance that you need it to go. And so we want to really make sure that you are getting those four things and getting the full distance of the real estate portfolio. And that's why we specialize in taxes and try to tailor it to your needs.
Great. And you're right about the planning, so because, yeah, and it might still be okay to do some planning this year in 2023. I mean, we still got a couple months.
Now's the best time. Yep.
Yeah, there might be something you can do, and hopefully we're going to maybe hear you talk about something, but what do you see as the biggest mistake owners are making when it comes to their taxes? Because they bring you up wherever they're at. What do you see as the biggest troubles?
Yeah, it's tough. I think there's really 5, and I'll touch on at least 2. I think one is procrastination, right? So we wait until the end of the year. We wait until April 15th to try to think about taxes, when in reality, this is a year-long process, and we should be thinking about this from January 1 to December 31. And especially during this time, October 1 to December 31, this is where we really get ahead of the ball, and how you can take advantage of that internal revenue code, that tax code that does incentivize you to make these decisions. Because we meet with so many people who are like, I got into real estate thinking that it would decrease my taxes, but I'm just left more frustrated and less wealthy because half my paycheck is going to the US government. So one is procrastination, and 2, we kind of touched upon it off air, LeAnn, was this trying to do it on our own mentality, right? Is not being able to delegate, not being able to ask for help. And I see this quite a lot, is people going on TurboTax, or even maybe going to H&R Block and just going for the cheap alternative. And let me tell you that cheap alternative might seem cheap on paper when you sign up for tax prep, but it ain't cheap when it comes to paying your tax bill and giving the IRS more money than they need. So I think out of all the reasons, the biggest one is either procrastination or trying to do too much on your own and not being able to delegate or bring other people into your situation.
I thought you would say maybe record keeping, because I mean, newer people, I coach new investors and people scaling, and, they do struggle with, QuickBooks, for example, like, oh my God, it's so hard if you're a one-man show to try to do that on your own, but other people can do that for you. But the setup is what will kill someone before they ever get started.
Oh yeah. Yep. We're dealing with a client now who had they had high 7 figures in business, and their books were a mess, and it came from that setup. And so if you don't get it right off the bat, you're gonna pay for it quite a bit down the road. And I'm glad you brought that up, LeAnn, because record keeping is huge. It protects you against audits, but I also understand that not everybody has the mind for it or even the time for it. And so we do try to come in and help you eliminate a lot of the overwhelm that comes with knowing that your books are a struggle. And so we come alongside you and help you in that, and kind of coach you along too. Is like, it does take some coaching, because it's like, what receipts am I supposed to keep? Where am I supposed to put this transaction? How am I supposed to keep my records? And just having somebody along the way, we've seen that pay great dividends for a lot of our clients.
Well, especially new businesses, my son is an entrepreneur and fairly new, and this part, he's a contractor. That's his skill. But over here in the record keeping, not so great.
Right.
So, I think that's typical of a lot of entrepreneurs. So we have to learn to get professionals to do the things that we aren't good at.
Yeah.
And
you have to understand the numbers. That's no doubt. And if you don't, then it helps to again have somebody come in and kind of walk you through it. But you don't have to be able to do it. And that is one of the first things that you should delegate, in my mind, because accounting is necessary, but it's also time intensive. And if you're spending so much time on accounting, that's less time for your son, for example, not spent getting new business or
Right,
worrying about
right.
his clients, or it comes in a greater cost than just like frustration, which is a cost in its own too.
And the other thing, having owned several businesses, like I owned magazines and whole other businesses, and I can say that as I progressed and learned more and able to read the P&Ls and the balance sheets, I could make smarter business decisions instead of
yeah.
wait till the end of the year, add it all up and go, oh my God, you know?
Yep.
Okay, so now what about everyone in real estate has heard of 1031 exchanges? What's
Yep.
the tax benefits for that?
Yeah, great question. And the tax benefit of a 1031, in short, is just a deferral of any gain that you would have. So again, we can talk about the different income areas that the government has, but there's ordinary income and then there's capital gain income, and capital gains are taxed at a different tax rate than ordinary income. But 1031 exchange is a way to defer, so not completely avoid the tax on the sale of a capital asset. So whether it's your real estate business, your stock portfolio, like all these are capital assets, a business in general. 1031 helps you defer the capital gain on real estate assets. And it's basically, again, it takes a lot of planning because there's, like you mentioned, LeAnn, time restrictions as to how you can approach that, like when you need to buy the next asset, when you need to find the next asset. And so it's very important. And then there's also restrictions on how you can keep the money, and like, so you sell one property and you 1031 it, you have to put that money somewhere so the government knows that you're not touching it. And so it requires a lot of the parties to be involved, but essentially it's deferral of a gain from the sale of your capital real estate asset, and it's paid dividends for a lot of our clients and will continue to do so because yeah, you're able to take the sale of the property and then go up into another property and rinse and repeat kind of thing.
Especially if you're scaling like I did, that tons of 1031 exchanges, but I did get backed up against the wall. Like you said, I couldn't find, I identified 3 properties. One fell away, the second fell away, and I only had one left and I didn't really want to buy it.
Yeah.
And I bought it.
Yep.
And that turned into, that was not a good decision. I would have been better off paying the taxes.
Right. And these are things you need to consider and sit with an advisor, because we're talking with another one of our clients just today, got off the call with them. And it's like, okay, what are your goals? Where is your biggest concern? What's the future look like? And how can we make sure that you're planning for that and not adding stress that doesn't need to be added to your plate? So
yeah, and it's a great strategy and it paid off
yep,
generously.
good.
You know, in to do it that way, to grow that way. Okay, so what records do I need to keep for tax purposes as a real estate investor? Like what do I got to keep?
Pretty much everything. I mean, you gotta.
I knew you were going to say that.
Yeah, any income and any expenses. So obviously as a real estate investor, you're collecting rent. You got to keep track of the rents. And then expenses, the IRS says business expenses that are ordinary and necessary are deductible. And so you can get a general idea of what's ordinary and necessary in the real estate business, but then it's like, okay, are there other expenses that might be ordinary and necessary that we can bring on to our record keeping? And that's where meeting with an advisor and making sure, because there's also tax law out there that either says you can't take that expense or you can take that expense, and it's important to be up to date on that. So yeah, I would say as far as record keeping go, the more detailed, the better. We meet with a lot of people who want to take into account their car expenses or their house expenses, but they're missing the ball on tracking mileage and expenses and all these different things. So Again, meet with somebody who can walk you through exactly what needs to be taken care of, but I can't overemphasize enough the importance of good record keeping, and if when in doubt, keep record of it, I would say.
Yeah, when in doubt, keep it. You know, that has entered a lot of discussions in the last couple, 3 years because of short-term rentals. A lot of people will buy their Florida home or whatever as a second home,
Yeah,
but really they're buying it as a short-term rental. Now we're bending the rules a little here, right? And then they want to go down there a whole bunch of times, and then that makes it, now wait a minute, is it a second home? Is it a short-term rental? What the heck is it?
right.
Or is it just your vacation fun land? And you know, you got some rules to follow to make that fit the
Yep,
code.
exactly.
So you better know what the rules are, or you probably are breaking them.
Right. Or at least find somebody that knows the rules, and
Yeah,
something like that. There's definitely some rules that you can take advantage of.
right. So that's where I see a lot of it. And because the pandemic, you know, a lot of people bought a lot of short-term rentals, and the market is shifting on those. It's different now.
Oh yeah.
You know,
Yep.
so what do? How do you compensate, and what can you write off? I was talking to a guy down there in Florida, and the hurricane didn't hit the beach where he owned his short-term rental, but the debris came up, and you know, it's on the beach and it's not going to be cleaned for this whole year. He lost all of his business.
Wow.
Everybody canceled. Like, what do you do? Right.
Yeah.
So, okay. I got another one here. You know, are there, you know, this is a tough one, but are there any tax advantages to holding your real estate in an LLC or some other entity? Does it matter?
Yes, entity structure matters a ton, and while there's no tax advantages to holding your property in an LLC, there are tax disadvantages to holding your property in a different corporation. And just like my client that I was talking about earlier, like they're, for every $100,000 they're making, there's a chance that they're paying an extra $20,000 in taxes just by having the wrong entity structure. So yeah, meet with someone, and I see so many people that are taking the advice off of YouTube or Instagram or TikTok or LinkedIn, and it's just not solid, and they did it because somebody on Instagram said it, but they didn't have the personal attention to decide whether that was the right decision. So yes, entity structure matters. No, an LLC is not going to provide you any tax benefit, but it's wise to have, because it makes you more, again, audit proof and liability proof. It's a limited liability company, so it limits your liability to everything that's in the business that you're running.
I think you said this really well, because so many people, they hear it on YouTube or wherever.
Yeah.
Hey, you got to have an LLC for that first property. Yikes. They run out and get it. Or they even get the LLC before they ever get the property. Okay. And now I got it. I'm ready. But as you said, that is a protection of your assets, but that isn't the tax strategy.
Right.
But they think that is. So then they
Yeah.
think, okay, I got it all covered. I'm all done. And then the year gets over and it's tax time, and they're like, huh?
Yeah. Yep. 100%. And then even just to go a little deeper on that, there's some advisors out there that will tell you to go create an entity in a specific state, and then you meet with somebody and they've got 7 LLCs in 7 different states, and that's going to become even more of a problem, because there is tax law coming out, and it might not even be tax law. It's a law coming out that is requiring you to, they're increasing the reporting standards on the LLC. So if you have 7 LLCs in 7 different states, the amount of reporting that you have to do just got a lot harder, and that's something that there's some people that have taken that advice and run with it, and now they're going to be in for a big headache, or even a big penalty bill when next year passes.
Wow. Okay. And now what about, let's say I'm a flipper. Okay.
Yeah.
how can I offset these capital gains? Because obviously if we fix it and we sell it, all in that year, it's unless we live in it, it's capital gains.
Yeah, so actually, like that's a common idea that gets tossed around, but flipping is taxed completely different than real estate, holding real estate. And again, this is so important to meet with the right advisor, because yeah, if you're not careful, you could start flipping and you might think you're going to be only paying capital gains tax, which is again lower than the traditional income tax rate, but that's not the case. Flipping is taxed at your ordinary income rates, and that opens the door up for other taxes like self-employment tax, and so it's just so very important to make sure that you are, one, recording yourself correctly, because again, the record keeping on flips is different than the record keeping on rental real estate, and then two, getting proper tax planning advice, because if you're not working with a real estate tax specialist, they might tell you, yeah, you're fine, you're only paying capital gains tax, but in reality, you're paying ordinary income tax. And if you do enough flips at enough of a income level, you're gonna quickly get up to that 37% tax bracket, and that's not going to be a fun conversation with you, your family, your spouse, whoever it is that is being welcomed into your financial life. So yeah, I'm glad you brought up the idea for flipping, because again, this tax code is very complex, and there's a lot of ins and outs to it, and something like the flipping and the developing is something that they call out specifically, but if you're not working with the right person, they're going to miss it.
Well, and the thing about the flipper, I mean, I help people decide, should I buy this or shouldn't I? And it'll cost me 30 grand to fix it or whatever the numbers. And then they come to the realtor, the broker, and they say, okay, what's the after repair value? Okay, so we give them a number, but what they forget in all their formulas is if they're using hard money, it's 15% minimum. Yeah. Just add that on. Right. Add on the fact that if you're a flipper and you think it's 30, it's probably 40 or 45. Mm-hmm. I mean, it just is, especially if you're brand new. And then they forget to put any tax issue in there at all. So they think, okay, I'm going to walk away with 25. Well, now that just went down to 10, Seriously.
Yep.
So that's why I'm cautioning flippers. You better figure out that it's a bigger picture.
Oh, yeah. Yes, it is.
Yeah. And yet there is some good tax strategies, but you gotta have them planned in before you get started and walk around saying, yeah, I made 50. Not really.
Mm-hmm. Right. And again, just to go back on a point too, tax strategy is one thing, but the bookkeeping, especially for flipping, is a whole nother thing as well. Because especially if your flip might be within that 12-month period, but it's kind of going into that next year. So you brought a bunch of expenses on, and you fast forward to, so you start the flip in October, start the repairs October through December. If you're not working with the right accountant and you don't have good record keeping, you could be opening yourself up to an audit that you will lose if your record keeping is not correct. So the flipping record keeping is very unique, and people should be aware of that and should seek out advice when they're taking it on. Because costs associated with flipping are higher, but it's also a very fruitful venture, and we've seen a lot of people have success for it. But we want to make sure that you're starting off on the right foot and accounting for a lot of these.
And that could, just like you said, you started it in October, you have all your expenses heavy that year, and then you don't sell it till March or whenever it is. Now what do you do? Which year is it in? Yeah. And there is ways to manipulate some of that if you're smart.
Exactly. Yep.
Yeah. But you got to have someone smart to be able to know that.
Right.
Okay. Now, what tax strategies can help minimize your overall tax liability in real estate investing? Is there anything?
So it's going to depend on person to person, right? Like if you meet with somebody who might have a generic idea about real estate, they'll probably toss out some buzzwords and tell you it works for everybody. But I'm telling you, we've met with enough people to know that if I say cost segregation, somebody might go and run with it and get a cost segregation study and not have the benefit. And somebody also might hear this and say, oh, I don't want to do cost segregation because I don't know if I can take the benefit. And they're kind of in the perfect position to reap the benefit, and they miss out on it because they didn't take that action. So it is very unique to everybody's situation. So I don't want to like say it, but I think the best way to find out is by meeting with somebody. And again, this is something that you can do for free, like having a sit down discovery call with our team to dive into your unique profile. We tell you about where you're making mistakes, where you've missed out on opportunities, and how we can plan to solve it. And that's really the best way to get the best bang for your buck, to make sure that you're doing the best thing for yourself.
That's great. You know, when you say cost seg, I remember, I don't know, for me, and this is me with my knowledge level, I thought, okay, that's mostly for commercial properties, or that's for people with larger portfolios.
Yep.
And then, of course, I know guys who are cost seg guys, and I remember the first time I heard, hey, my son did it on a duplex and it worked. And I'm like, what? You know, so I just had that presumption that it was only if you're a certain level. Yeah. It all depends. Like you say, I don't know whatever else that other person owned, but for whatever reason, he was in position.
Right. Exactly.
Yeah, but you wouldn't know. Okay, it looks like we have a question here. So Jennifer says, if I lost money in stock for 50K and I made money by flipping a property for 50K, does that offset each other?
That's a good question. And again, it depends on a number of different factors. I think timing is the biggest thing. So with stock, it's the same thing as real estate. Like if you hold it for less than a year, it's taxed one way. If you hold it for more than a year, it's taxed another way. And same thing with the flip. So there's potential for a great tax strategy there, Jennifer, but without knowing the full details, it's hard to say whether it will work. And again, probably both less than 1 year. So
that's great what you said of it's a timing thing, because if someone came to you now and let's say they're in the middle of that flip or whatever, or they were going to put it on the market right now, maybe they would want to wait, or, you know, you can make those decisions then instead of, oops, I did it already and now I can't get that benefit.
Right. Absolutely.
Okay. Did we answer her? Yeah. Both less than a year. So that changes a lot of things. Yeah.
So Jennifer, the best thing I can tell you is to sit down with somebody and make sure, because there's definitely opportunity there. And you want to make sure that you're meeting with somebody that knows the ins and outs of your situation and can take a deeper dive and make sure that you're capitalizing on it. Because if you don't get the full benefit, you're probably looking at least $20,000 or $15,000 to $20,000 worth of unnecessary taxes.
Ouch. Okay. And can I deduct home office expenses for my real estate business? I know I do because I have dedicated office space, but a lot of people will ask that who own a couple of properties.
Yeah, no, it's a great question. And it's one of the benefits that we see is often missed, but it does depend on situations. I think the best way to tell is if your primary place of working is where you have your home office. And obviously with COVID, a lot of people were claiming home office deductions, but they were working a full-time W-2, and that is strictly prohibited. So if you're working a W-2, chances are that you can't have the home office for your W-2, but if you have a real estate business, there's a great probability that you are able to capitalize on the home office deduction, which opens up a whole window of opportunity for you. So yeah, a lot of people in the real estate world, especially if they're agents or brokers like yourself, LeAnn, it's a great opportunity that saves people at least, I mean, we probably estimate savings of $3,000 in taxes just from home office, and that's probably being a little conservative.
Okay, and then, there is tax benefits, I think, with low income or opportunity zone, that kind of thing. There's tax benefits that come with that stuff, right?
Yeah, so this is something we talked about at the start. Again, if you think about it from the government's perspective, where do I want people investing? Where do I want to see economic growth? And one of the places would be those low income housing. So they do incentivize you investing in those areas. But again, the tax code is constantly changing and there are time limits. So something like the opportunity zone, it is being phased out here in the coming years. And so if you're meeting with somebody and he's like, yeah, just throw your money in this opportunity zone, and you'll get the tax benefit. Well, you'll come to find out in 2 years that you're probably going to pay that tax a lot sooner than you would have if you seized the opportunity 10 years ago, or even if you seized another opportunity that could be on the horizon. Again, something like there's tax changes coming out and they're constantly being discussed about in Congress. And so it helps to have somebody who's got their eye on the ball and is planning, because yeah, there's definitely some opportunity, but there's also some things that are getting phased out that you want to be aware of.
Yeah, because what if you put your money in a syndication that was all about opportunity zone, and like you say, you're planning a 5-year whatever of your investment, and now it changes.
Yeah, because the thing about opportunity zones is that you have to, like, it's similar to 1031 where it defers taxes. So if you had the idea that you were deferring taxes for however long, and then fast forward 2 years and it's a lot sooner than you've thought, then you're going to have a bill that you weren't expecting, and you're going to be upset at whoever it was that was advising you.
Okay, how about, is there, I know I did this way back. They had incentives, and I actually got grants from the Center for Energy on windows. Like I had old 1900 duplexes, and we'd get all free windows from the Center for Energy. It was an incentive. I didn't get a tax write-off, but I got free windows.
Yeah.
But there is, there can be tax credits or incentives around, but you better be talking to someone who knows about these things, or you're going to miss out.
Yep. Yeah. So that kind of goes back to like the energy, like the government will want to incentivize people to invest in energy. So oftentimes, and they continue to come out with new energy credits, but there's a lot of fine print involved in those, and you'll want to be with somebody who's kind of got their head wrapped around it. And it also varies state to state. So I know like California and Minnesota differ on how much the credit is, and so locale is definitely important as well.
And I just read recently about tax loss harvesting. I had never even heard that. How does that work?
Yep. So this is an interesting topic. It's this idea that if you have losses in your portfolio of stocks, then you can go and sell off a bunch of stocks. And then in the past, it was like you can buy it back. So like sell off a bunch of stocks December 30th, wait 4 days, January 2nd, buy it back, and you just got that tax loss and didn't and still had the stock at a loss. Now I want to say that is now gone, right? The government caught on to that, and so there's some time periods that you have to be aware of and should be aware of. But the idea is that if you're willing to take on the risk of the time period, you could potentially sell a stock at price A on December 15th, and then once it's outside of the time period in January or February, you can buy it back, but you have that risk now that you're buying it back at a higher price than you
Right.
had it. But yeah, it's worth pursuing, and again, worth kind of strategizing with somebody that you trust and have the confidence in to give you the right advice. But
You
yeah.
know, it seems like we keep coming back to, you better plan.
Mhm.
You've got to plan, because, and that's what the wealthy do. They plan this stuff out.
Yeah.
And so what's the difference between tax planning and tax preparation?
That's a great transition into that conversation. I like how you did that, LeAnn. Tax planning it's that year-round advice. It's like, you know, if I want to, so tax planning is year-round and strategic and proactive. Tax prep is reactive and gives you your tax return as well as your tax bill. Tax planning will probably incorporate your tax prep because you've been planning together all year round, and probably a tax bill that's much less than what the tax prep will provide you. I like to think of it like I mean, we point oftentimes to the health industry. So if I'm thinking about the health industry, I can go to a general practitioner and do a checkup once a year. And if I'm not careful, that checkup might not offer me news that I want to hear, right? If I didn't take care of my body for the past year, a doctor might tell me I gained 20 or 30 pounds, and it's going to be a little unfortunate. But if I was proactive and maybe meeting with a trainer every 2 months and kind of discussing workout plans and nutrition plans and all these things, then the time I go to see my doctor come checkup time, it's a lot easier to handle, and I don't have that extra weight. And so tax planning is like meeting with the trainer on a regular basis so that you can create a plan to release the extra weight of taxes, whereas tax prep is like, yeah, we saw that you gained $20,000 of weight, and you have to pay the bill for the IRS. So proactive versus reactive, relationships versus transactional. That's really the big difference between tax planning and tax preparation.
Great. Okay, folks, we're getting ready to wind up. Now, what I want to do is give you the information here. If you have any questions, go ahead and ask or put them in the chat box. And I'm going to just share here real quick how you can get in touch with Chris right here.
Yes.
I have
Yes.
a scan code here.
Yep. So if you scan that, we have set aside time, I believe the next 3 days, to meet with some of you folks and kind of get a better idea of what you're going through, and then see if we would be a good fit to work together, and then kind of talk about meeting to take that deeper dive, and that would be 100% free, and it is our gift to you is a consult to go deeper into your tax profile. Because again, I know a lot of this is like, yeah, it pays to meet with somebody, and you want to meet with somebody, and so we're giving you an offering and an opportunity to meet with us to dive deeper into your unique circumstances.
That is great. Now, and I have a couple investors I know that I've sold property, and they sent me a message, oh no, I can't make the call, but they know that all of these are recorded, and I will send it out to my entire list here in the next, like usually in a couple weeks we put it out, and so there is a way for you to get this. Okay.
Yep. Yeah. So if you just reach out to me either via email or Facebook, my email is chris@betterbookaccounting.co. And if you put in the subject line, LeAnn Riley, real estate investor meetup, and shoot our team a message about wanting to take advantage of this opportunity to sit down with our team, then we'd be happy to grandfather you in and give you that opportunity, because I know that, yeah, there's a lot of people that I'm sure are Thank you, LeAnn. Yes.
There, I put it in the chat. Did I get it right? Chris at
Yep.
betterbooksaccounting.co.
Yep. And you
There
can
we
also
go.
find me on Facebook and LinkedIn. I can actually pull those up and kind of paste those.
Okay, he's putting those in the chat, and I'm threw up the slide. You can always get a free strategy session with me to talk real estate. I can talk about my coaching program where I help people get started or scale. Or if you happen to be in the Twin Cities from Rochester to St. Cloud, I run a team of agents. We can chat about that and you building your portfolio. And then there's one more thing here. I do have a Facebook community called Real Estate Investing Made Simple. It's a group, Facebook group. You can join that. It's free. And in there, I post a lot of just new news or what's going on in the mortgage market, things like that. Now, I see we have a couple more questions. Let's see what we got here. Yeah. Oh, would you put phone number here? I can scan. Put email here. I'm maybe she wants, I'm not sure what. Jennifer.
Yeah, Jennifer, if you reach out to me on email, we can set up a time to chat because it definitely seems like you got a lot going on, and we'd love to help you out and make sure that you're taken care of.
Good. And he put all this right there in the chat.
Yep.
So anybody who's here live, which is really great, you can grab that link. When the people who come on here afterwards, it'll be tougher. They'll have to get that scan code.
Right. And again, it's Chris McCormack CPA, MBA, CTP on LinkedIn, and then Chris McCormack on Facebook as well. So, and then Chris McCormack CPA on Instagram. If you're on Instagram, we don't do terribly much, but we will continue to put out content and help you guys.
And then your podcast is on what? Is that on
Spotify, Apple, really anywhere you get podcasts?
Okay,
yeah.
what's the name of it again?
Know Your Numbers, REI. And it's been like twice a month, probably more so once a week now that we're kind of getting our systems and people are in need of more advice. So tax and accounting advice for real estate investors out there.
Okay, well, I just want to thank you for coming on and sharing with us some of these tips, because we all need to minimize our taxes, right?
That's right. Yes, biggest expense of our lifetime, but they don't need to be. So yeah,
right.
No, thank
they don't
you,
need
LeAnn.
to be.
This has been great. I'm so glad that you're doing this, and you are changing lives. So excited to be a part of it.
Thank you. Thank you, everybody, for coming on. And we will see you next month. I am going to get someone about these crazy mortgage rates and what the heck, I got a really great guy about creative financing, and we're going to just bring that out in the open and chat about what the heck's going on.
Yeah, that's awesome.
All right. Thanks, everybody.
See ya.
Bye.